Thanks a lot for having me in the seminar series, this time remotely online. I hope that at some point in the near future I can also actually come back to beautiful Chile and Santiago. This is joint work with Olli Kolbjorn, Jörg Godnichenko, and what we are planning to do in this paper that's part of a broader agenda is to shed a little bit of light on some real-time estimates for several macroeconomic quantities that are of interest not only to academics but potentially also to policymakers. And I think it's fair to say that the arrival of COVID-19 for most of us has been the biggest, or at least one of the biggest economic shocks we have witnessed during our lifetime. And while typically the type of research we are doing is not actually of questions of life and death, at least immediately, I think this time actually quite a few of the questions we've been trying to tackle and answer indeed actually directly involve the liveliness of the economy and the lives of many individuals. And in this very environment, well, typically actually I think it's no big deal that, let's say, the official unemployment numbers or things like that by the Bureau of Labor Statistics are released with a time lag of a couple of weeks. I think this time many of the decisions policymakers were facing heavily relied on inputs about key macro quantities, but those numbers typically actually are only released, as I was just arguing, with a substantial time lag. And so that's a little bit of what we've been trying to do in a series of papers now, where we try to provide some real-time estimates of labor market statistics, spending plans, spending decisions, expectations that are, of course, crucial for any forward-looking decisions households and firms are undertaking. And the way we're actually tackling this type of endeavors is through large-scale surveys that we've been running on the AC Nielsen home scan panel for the last couple of years on a quarterly frequency. I'll be way more precise in terms of what those surveys are, how we design them, and what the Nielsen panel is, in case some of you were at the conference at the Central Bank of Chile in October. My co-author Francesco D'Acunto presented another paper of ours. As far as I remember, I think he was also presenting some work using the Nielsen survey, so you might already be familiar, at least at some level, of this type of setup. And then specifically what we are trying to talk about in the current paper is, on the one hand, getting an idea at the time of the survey, so in April of 2020, so when just actually COVID-19 started widespreading in the US, what happens to consumer spending, what happened actually to the labor market, what actually happened in terms of personal income and wealth losses due to the arrival of the pandemic, but then also a little bit, you think about, now a big shock arriving, there's typically we see, at least at the aggregate level, some form of a flight to safety or a flight to quality. Do we also see something similar at the individual level? Do individuals reallocate their portfolio? Typically, of course, portfolio allocations are rather sticky, but do we see now, to the arrival of such a big dramatic shock, people actually reallocating their portfolio? But then ultimately also what we are interested in are subjective expectations of individuals, not only for their own job prospects, but crucially also for interest rates going forward, for the unemployment rate in the aggregate, but also, given that they are a key input in consumption decisions, also ultimately the inflation expectations and inflation uncertainty. So the first part will be rather descriptive. We want to understand, is it the case that in April things have changed relative to the previous survey wave that we had in the field in January? So we have a pre-crisis wave and a crisis wave. Therefore, we can actually, within individual, compare all of these statistics. And then linking back to our initial question, we want to understand, in case we actually find big changes in individuals' behavior and decisions, to which extent are these now changes that just occurred because of the arrival of the pandemic? So is it because people actually are scared and don't want to go out anymore? That's why we might see actually big change in spending. Or is actually maybe some part of this drop in spending we might observe due to the imposition of lockdowns at the local level, shutdowns of businesses and service providers. So that's pretty much what we are trying to achieve in this series of papers. So now actually in one slide, let me just tell you a little bit some of the baseline findings we have, and before going into details in terms of survey design and empirical implementation. So just actually overall, we have about 10,000 individuals in each of our survey wave. But a little bit less than 50% of those 10,000 people actually report in the first wave of April that they actually lost income due to the arrival of COVID-19 of about $5,000 as of early April. Even more than 50%, this is now we have to recall, so early April, this was still a time when we saw dramatic drops in stock market valuations. We see that more than 50% of our panelists actually report having lost wealth due to COVID-19, and conditional on losing any wealth, the average decline was actually more than $30,000. By now, actually, we just got preliminary data from our current wave that was in the field in July. So here we see actually about 50% of this drop has already recovered, mainly due to the recovery of the stock market. Now, in terms of spending, you actually see that overall spending contracted considerably, about a third of spending relative to spending in January. But of course, you know, this overall number is actually camouflaged in quite a lot of cross-sectional heterogeneity. Like many of you, I was also not able to travel for several months. So you see in the data that leisure, travel, and entertainment are categories that saw substantially bigger drops in spending relative to these 31% numbers, whereas other categories such as, for example, you know, groceries and things like that didn't see nearly as large drops. Somewhat interesting, and I'll be more precise on that later on, you also see both at the extensive margin, but also on the intensive margin that people stop paying for or servicing their debts. On the one hand, you see a big chunk of people stop paying, let's say, their mortgages or their auto payments altogether, but even conditional on actually still servicing that outstanding debt payments, you see still see about drops of about 25-30% conditional on repaying any debt. And so, of course, this might then also help explain why we saw in the last couple of months this big increases in loan provisions by major banks in the US to be effectively prepared for a potential wave of defaults going down the road, even though right now, thanks to very generous additional unemployment insurance benefits, it looks like actually, at least so far, this wave of default hasn't actually materialized yet. Of course, those are merely actually numbers now looking through the rear mirror, in the sense what happened before April of 2020. Ultimately, way more interesting is, of course, what people think actually they plan to do going forward and what the expectations are for macro quantities. So here you actually see a quite dire view of the economy, in the sense that it's as of early April, we saw that planned spending on durables, so larger ticket items such as cars, houses, furniture, or big ticket electronic items actually plummeted by 30 percentage points. And also here again, we see quite some heterogeneous response across different categories. Now, in terms of actually labor market statistics, on the one hand, you see that, as we of course by now also know from the Bureau of Labor Statistics, that quite a few people actually are no longer in employment. So we saw a dramatic drop in the employment to population ratio. Something, however, different from what the Bureau of Labor Statistics has been telling us. We saw only a mild increase in the unemployment rate in our survey. And the big discrepancy between our survey and the current population survey that the BLS is using to measure official unemployment statistics is that we directly ask individuals whether they're actively looking for employment, and conditional of them saying, well, they're not looking for employment, we elicit different reasons for not looking, searching for employment. And here we actually see that a big chunk of the people that drop out of the labor force, according to our survey, in April, relative to the pre-crisis wave in January, actually report that they entered early retirement. Now, of course, we know from at least previous surveys and other works that typically once you enter retirement, it seems to be like an absorbing state. So even actually if now the economy would fully reopen, we would have a vaccine, and so therefore wouldn't have to be concerned maybe of contracting the virus. It might still actually promise a somewhat protracted recession and slow recovery if just a big chunk of the labor force, of the population is no longer actually in the labor force. Now, in terms of uncertainty, and this is actually somewhat also consistent with what many economists were saying as of early April. So on the one hand, you could say, given the big drop in aggregate demand, inflation should go down. On the other hand, it's also, of course, a supply shock. So therefore, we might expect marginal costs to go up and maybe firms raising their prices. So on the one hand, we see, at least in terms of first moment, that inflation expectations decreased by about 0.5 percentage point on average. But also we saw a substantial increase in the uncertainty of individuals. And of course, this increased uncertainty might also partially help us explain why we might see this drop in planned spending due to potentially precautionary savings demand. And finally, in terms of other expectations we were eliciting, you see that the unemployment expectations skyrocketed by about 13 percentage points. This is actually for next year, 2 years down the road, and even as far out as 5 years, individuals still expected a higher unemployment rate by 3 to 4 percentage points, again suggesting a very sluggish recovery, certainly nothing looking like a V-shaped recovery. And in terms of interest rate expectations, so here we effectively saw a parallel downward shift in interest rate expectations, in the sense that individuals expected mortgage rates to further decrease by about 4.4 percentage points from already historically low level throughout the whole term structure of interest rate expectations that we were eliciting. And then the second part of the talk today, what we try to do is a little bit disentangling which part of those numbers or changes in spending and plans are due to now the arrival of COVID-19 at the local level. So maybe I see in my country someone is contracting the virus, I get scared, I don't show up to work anymore, or I stay home to take care of family members and things like that, or which part might be due to local politicians imposing lockdowns in terms of stay-at-home orders, lockdowns of businesses and service providers. And it looks like actually a big chunk of the numbers we are just discussing might be a direct effect of lockdowns rather than the arrival of the pandemic. So now, before actually going into details, let me actually pause for a second and see whether there are any questions.
No questions now, Michael.
Okay, perfect. So now let me tell you a little bit about the type of setup we've been exploring for a while now. So we've been running customized surveys on the so-called AC Nielsen home scan panel. So the way to think about this panel, so Nielsen is a marketing company in the US that has a consumer panel consisting of about 40 to 60,000 households in the US in terms of demographics as representative of the overall population. As you can imagine, in terms of age distribution, income, education, marital status, where they're spread out across the US, number of kids, and things like that. And in addition, we also directly get projection factors from Nielsen to just actually make all of our survey responses, because of course not everyone is always responding to the survey, representative to the overall US population. And the reason why this panel is called the home scan panel is that all of those panelist households, they actually have an optical scanner at home, similar to what you are familiar from supermarkets. And so whenever these panelist households would purchase anything with a barcode, something like those lines down here, they would actually then at home take out this optical scanner and just scan it, enter the price they paid, but also where they purchased. And so effectively, what you observe for these panelist households is the overall non-durable consumption bundles, so groceries, pharmacy items, and things like that. Now, of course, you might be concerned that lots of the things actually people report might be biased. They might actually be somewhat, lazy, not scan everything. So Nielsen tries to actually, given that it's a key part of their business, to ensure that households only fully report their spending. On the one hand, they compare their spending, let's say this month in July, to the spending of the household in July of 2019. They also condition on a minimum amount of spending. They provide actually like goodie points for each item household spend. So think about like your preferred airline, frequent traveler program. So whenever you fly, you get miles, and with those miles, you can purchase additional flights and things like that. So Nielsen does something very similar. And so this is pretty much the type of population we are using to field our surveys. Now, at some point in 2015, in February, I think, we figured out that actually Nielsen not only elicits the spending behavior of individuals, but also actually runs smaller scale surveys on that panel on a monthly frequency. So typically, a US researcher could actually then field 1 or 2 questions on like 2,000 panelists. And this is something a few people have done so far. But crucially, we figured also out that there is actually a more customized solution that is typically used by large retailers and sellers of fast-moving consumer goods to, for example, figure out now, target group specific marketing campaigns, or like potential demand for before a new product is introduced. And so this is the type of setup that we are using. So for now about 2.5 years, we've been fielding customized surveys on a quarterly frequency in cooperation with Nielsen on this panel. And crucially for the talk today, we actually will talk about 2 waves that were in the field in January of 2020 and in April of 2020. So January will be our pre-crisis wave. April will be our crisis wave in the middle of the first wave in the US. And so we fielded those 2 waves of the survey to all members in panelist households. So for some households, we've not only the male or the female household head, but we have both male and female in the sample. So now one of the nice advantages of this Nielsen setup is that it's just so much bigger in scale relative to alternative survey providers sometimes people use. So think about the Michigan Survey of Consumers or the more recent New York Fed Survey of Consumer Expectations. So we have between 10 and 50,000 respondents per wave, whereas these surveys only have 500 or 1,500 responses, which of course allows you to drill way more into potential heterogeneities and things Olli and Yuri and I have done in the past. Also, for example, do different information treatment experiments where you can just actually have way more information treatments in the same population. For example, right now we are working on a revision for a paper on monetary policy communication for the JPE, where we actually see that within the same panel, different centers of information react quite differently in terms of updating of inflation expectations. So now in terms of response rates, we see in the January wave a response rate of about 1/4, which meant, given our sample in January, that we have about 18,000 responses. Similar response rate in the April wave, this time slightly smaller overall sample. So we had actually about 14,000 respondents. And so in terms of overlapping households, we have about 6,000 individuals that participated both in the January and the April wave. And those will be the households we are focusing on today, because we want to see how individuals within individual over time change their behavior once the pandemic has arrived relative to before. So in terms of survey questions, I don't actually have the full survey with me, but just a little bit of a selection. So we start out asking individuals, how much did you spend any money on a whole list of categories that you'll see in a bit, and then conditional on responding, yes, I spent in the last 3 months any money on these categories. They are asked to report their monthly dollar spending in these categories. So this will be then the data we are using to get an idea how actual spending has changed overall and across categories. We also say, did you lose any income due to the arrival of COVID-19? And then conditional on having any saving, we ask them what happened to their wealth due to the arrival of the corona pandemic. We also elicit subjective expectations, so inflation expectations similar to the New York Fed. We directly ask about inflation, rather price of goods people spend money on, as in the Michigan survey. And then also, what do you think actually will happen to the unemployment rate for the overall US in 1 year, 2 years, and 3 to 5 years? Similar for the mortgage rate, 1 year, 2 year, 5 to 10 years. And then also spending plans, both at the categorical level, but also for durable spending. Similarly, as before, we say, well, conditional on any saving, could you actually tell us how you invest your saving in different pre-specified categories, equity in the US, international equity, treasury bonds, corporate bonds, a little bit of gold. Here we always ask about Bitcoin, so we've also Bitcoin in there. In our sample, effectively no one, barely anyone invests in Bitcoin. And then given that we have this panel, we can actually compare portfolio allocations between April and January before in our pre-crisis wave. And then at the end, we also talk a little bit about how people rate the work of different political institutions on a 10-point Likert scale. So 1, poor performance, 10, good performance. And so here we see actually that especially the CDC has a very high approval rating, whereas our President Trump actually doesn't actually fare all that well. So now what we actually want to first do is talk a little bit about 3 key labor market statistics. So the first one is the employment to population ratio. Then we want to talk about the unemployment rate. And then third, we talk about labor force participation. And so what you see here in red is just actually the difference in our January wave that was in the field throughout January, and then our April wave that was in the field in the first week of April. And specifically, we asked individuals in the survey whether they are currently working for pay. Now, this question differs slightly from what the Bureau of Labor Statistics is doing, in the sense that the BLS typically has a specific reference week, and then they ask individuals of whether any portion of that week individuals worked for pay or profit. So given that we only have actually a point estimate versus on the single day versus the BLS as well, any part of the week. So we actually indeed see slightly unconditionally slightly higher lower employment to population ratio in our survey, but actually in the cross section of states, it almost lines up perfectly with what the BLS is reporting. Now, if you actually look at what happens between January and April, you see actually a tremendous drop in the employment to population ratio of almost 8 percentage points. And just to put that a little bit in historic perspective, we also show this the evolution, the time series of the employment to population ratio starting in 2006. And you see that within the first quarter of 2020, the drop in the employment to population ratio just dwarfs whatever we've witnessed cumulatively during the Great Recession. So just a dramatic decline in employment. And now if you were to actually translate this employment to population ratio drop into new unemployment claims, we actually would have predicted in early April that 20 million people lost their jobs as of first week of April, which is actually even bigger than what the Bureau of Labor Statistics was reporting at that time, 16.5% initial claims filed. And of course, this might just reflect the fact that the US is actually still using a somewhat antique infrastructure and computer system. There were many anecdotes of individuals attempting to file for for unemployment benefits, but just actually not being able for several days or even weeks. Now, in terms of actually the unemployment rate, the way we listed the unemployment rate is so conditional on individuals saying they're currently not working for pay or profit. We asked them directly whether they are actively searching for work. And again, this differs slightly from what the BLS is doing. So the BLS also tries to figure out whether people are actually actively searching, but the way they typically would do that is by trying to ask, well, have you actually contacted potential employers? Have you filed job applications and things like that? However, due to COVID-19 and all the difficulties that came with it, the fact that actually in-person interviews were no longer possible, they differed slightly this time in the sense that they provided guidance to interviewers. And whenever individuals that said, well, look, currently I'm at home, I actually still had a job like, let's say, 2 weeks ago, I'm unsure whether I will be recalled. The BLS gave guidance to interviewers to record these individuals as unemployed on temporary layoff, even though they were not sure of whether they would be recalled. So these are the slight differences in terms of survey questions. So if you now would look actually, yes?
I'm sorry, there's a question. Mm-hmm. So Marco, we're gonna open your microphone.
Hi, Michael. Can you hear me?
Mm-hmm.
I am asking if April is a proper time to observe the complete impact of COVID in this aggregate, or at least in non-crude rates as unemployment, for instance, regarding especially the public announcement of the government in this month. So maybe in a later month, like July, it could be a better survey about the response that you can get for the people because the incorporation of those comments.
No, Marcos, actually, those are great points. And so I think I briefly had mentioned it before. And we currently have a survey in the field, or was in the field until end of July, and we are waiting to get the micro data from Nielsen. So you're totally right that as of now, all we are doing is a point estimate or an estimate in a point of time, and we cannot really draw a full-fledged figure. And so that's definitely something we are very interested in and want to actually also see over time how different policy actions affected not only the official reported unemployment numbers, but also like job search behavior and things like that. So a big concern right now, and that's why the US Congress and Senate cannot reach an agreement, is on the one hand, Republicans are concerned that given that many people actually make more on unemployment benefits than they make from their regular job, that they actually just are no longer actively looking for work, whereas the Democrats say, well, this is not a concern. And so that's definitely something we want to actually study also and just actually get more than a single snapshot also now in the July wave of the survey to get a fuller picture on the developments in the labor market. That's definitely a good point, Marcos. So now just actually in terms of snapshots, so what you see actually, so on the one hand, you saw this dramatic drop in the employment to population ratio in the previous graph. If now all people that are no longer employed in April would have said that they're actually actively looking for work, we would have seen an unemployment rate in our survey of more than 16%. Instead, actually, what we saw in our survey was a pretty modest increase, relatively speaking, in the unemployment rate of only 2 percentage points, which still, of course, is the single biggest increase in a month actually we've witnessed for quite some time. And actually, it's about a third of the increase in the unemployment rate as we saw during the Great Recession. Nevertheless, of course, these numbers actually are quite different. And so here, this is quite different also from what the BLS was reporting, then about 4 weeks later after we had our paper. And so this big discrepancy can be explained that by the fact that, at least in our survey, we saw this tremendous drop in the labor force participation. So from January till early April, we saw that labor force participation decreased by almost 6 percentage points, which again, substantially larger than the cumulative decrease we saw during the Great Recession and subsequently. And so the way we elicited that was that in the survey, we said, well, are you working? If they said no, are you looking for work? If they said no, we said, well, there are several reasons why people might not be looking for work. So, people could be homemakers, could be students, could actually be on temporary leave, temporary layoff, and things like that. So we directly elicit for that, but also the BLS is doing. But crucially, also we asked them whether they are retired or retired early, and it looks like actually a big chunk of the decrease in labor force participation seems to be driven by earlier than planned retirement. So crucially, given that we only focus on the panel dimension for these numbers, the age distribution between April and January is identical. Well, of course, there's a 3 months difference, but this cannot explain why we saw an increase in the fraction of our survey respondents that claim to be retired in the survey of about 5 percentage points. Now, we saw actually, so in a univariate sense, that some of these numbers were already quite dramatic and special. So what we now briefly want to do is actually just get an idea how those labor market statistics co-move jointly and whether that's anything special. And so here what we are plotting is just at the monthly frequency on the y-axis, the unemployment rate as reported by the ELS and the employment to population ratio, where we typically see decade to decade changes in how those two key labor market statistics co-move, typically negative association, but due to changes in demographics and the structure of the labor markets, things are quite different a little bit in the 1990s compared to, let's say, the 70s. We see that this time is actually quite different in the sense that we see a big drop in the employment to population ratio with a rather modest increase in the unemployment rate. So here it looks like actually the current recession is different from normal business cycle movements. Similarly, and at the same time different, we see that again, typically a positive association between the labor force participation on the y-axis and the employment to population ratio on the x-axis. Again, some changes across decades. And while again, this time seems to be special in the sense that, you see just a way larger movement from quarter to quarter than we typically see, you see that the slope in terms of how those two statistics are co-moving are not special, it's rather the size of the movement that seems to be different from normal times. Now, what we already foreshadowed a little bit, what helps us explain to this somewhat different behavior in these labor market numbers seems to be largely coming from a wave of early retirement. So what do we have now here in this plot, graph? So we have on the one hand just the age distribution of our survey participants on the x-axis. On the y-axis, left y-axis, we plot the fraction of survey participants that report that they are currently retired. When we ask them in the survey, we do that on the one hand in red for the April wave, in the black dashed line for the pre-crisis wave in January, and then on a different scale, I want to actually highlight that in blue, we also plot the difference between the two survey waves. So if you focus for a second on the blue line here, you see that actually this difference throughout the age distribution is actually positive, which means that throughout the age distribution between at least 45 and 75, you see that a larger share of survey participants says they are retired in April, relative to January. But then you also see actually a quite noticeable spike in around age 64, 65, which is actually the very age threshold where individuals can start claiming retirement benefits without penalty. And so on. It looks like indeed actually that economic incentives are important. Once actually I don't face a penalty for retiring, I start doing so, especially then in the April wave, once I might also have personal health concerns. But actually it's not only when I can retire without penalty that people start retiring, but you also see a big chunk of early retirements for people that are actually before age 65. Now, I don't have much time to go into detail on that, but so if you actually were to look into different demographics that actually drive this increase in retirement, you see that it's especially women that predominantly start increasing retiring, but also Blacks and Latinos in the survey. So it looks like actually parts of the labor force that already ex-ante or previous parts of the labor force that were already a bit maybe more precarious and disadvantaged are the ones that actually predominantly drop out of the labor force.
Michael?
Yes?
This is Ernesto. I think that something useful for this figure would be to have confidence intervals, maybe covering some previous episodes of high unemployment.
I totally agree.
It doesn't go against the point. It just will make it cleaner, I think.
No, and I totally agree with you. So we were looking actually, especially also for some survey evidence from previous recessions. Unfortunately, we couldn't actually come up with some good micro data. Our own survey only started like 2.5 years ago, so we don't have that evidence from our own survey, but we are thinking of maybe doing some bootstrap or similar to actually indeed get confidence intervals actually for this figure. I totally agree with you.
Michael?
Hi,
Michael. Andres Fernandez here. Sorry if you already went by this and I missed it, but do you have information on whether these participants have received income from the fiscal stimulus package?
Yeah, so Andres, this is actually exactly the question we were asking ourselves. And so as of early April, there were no disbursements yet of the fiscal stimulus package. But so we then looked into the details, what determined the timing and the different means of distribution. And so that was actually a big focus of our July wave. So similar to like the previous recession, it effectively was a function of your income bracket in the last reported tax return. So we actually elicited this information, and we're currently working on getting an idea how much people are spending out of the fiscal stimulus checks the Trump administration was then sending out. And somewhat actually surprising happened, which is different, at least based on the preliminary data we got, that's different from previous recessions, is that the average MPC is actually way lower compared to previous recessions out of this fiscal stimulus checks. And instead, actually, you see that there's a big chunk of the stimulus check has been used to repay debt. So it looks like there has been a less consumption response and a bigger debt repayment response this time compared to previous recessions. But we don't have the full data yet, and we don't have a draft on that. But hopefully in a couple of weeks, Andres, I can send you some updates.
Yes, no, just to follow up, that would be great. That would be amazing. Because I guess where my question was headed is whether you can tease out something from this survey in terms of how the labor force participation decision was influenced by these payments. This is currently a big issue now in the negotiations for a second round of stimulus, right? Whether the extent to which that has these large sums have taken people out of the labor force. So that would be great.
That's the second thing that we had in mind also, Andres. Totally agree with you. So we asked them, so have you already received? Do you plan to receive? Do you think you will receive? And things like that. And then conditional and not being employed, we asked them whether actually they changed their search effort due to either having received or planning to receive those stimulus checks. And then conditional on still being employed, we were asking them whether they think this actually would change their search effort in case they would lose their jobs. And it looks like, at least within survey, and here it's crucial, so Nielsen never discloses to survey participants that the surveys are run for academic research. Survey participants actually did not, at least stated that they did not change their search effort, or conditional on still having a job, they would not change their search effort in case they would actually lose their job. So at least within the survey, conditional big shock and the current pandemic, it looks like actually those stimulus checks didn't affect search behavior, but that's only survey evidence, unfortunately.
Okay. Thank you, Michael.
Thanks, Andres. Okay, so the second thing is, one of the categories why people were could tick a box why they were not looking for work was also disability. And so here, a similar structure of the figure. So pre-crisis wave, crisis wave, the difference in blue on the right Y scale across the age distribution. So here this time, we actually again focus here maybe on the zero. You see that actually there's no clear dominance of one line always being above the other line or so. But what you clearly see is that there are spikes in reported disability by survey participants at the age of 50 and around age 60, which are the very age thresholds that actually make it easier for individuals in the US to claim disability benefits based on thresholds by the Social Security Administration in the US. So again, it looks like here at least economic incentives clearly play a role. And once I can somehow actually claim benefits in case I don't have current work, people actually on the one hand either retire or claim disability benefits. So that's pretty much what I wanted to talk about for the labor market. Now let's move on and talk a little bit about spending. And again, so remember what we said earlier, the way we elicit those spending responses, we first ask them, did you spend any money over the previous 3 months? So for the April wave, January till end of March, for the January wave, October, November, December, on the individual categories we have listed here, and then conditional on them ticking the box for this given category. They were prompted to report the average monthly spending over the previous 3 months for those categories. Now, of course, oftentimes, especially when presenting more to a finance audience, people are very concerned about the surveys being reliable and making sense, and how much can people recall what they spend money on. So what we did actually quite extensively in the paper is benchmarking the average responses in our pre-crisis wave to official numbers from the consumer expenditure survey. And so now, of course, there's no one-to-one mapping for individual categories. There's slight discrepancies. The CEX, of course, also includes larger ticket items such as durables. If you would actually kick out durables from the CEX, you would find an average monthly spending which is almost identical to our $4,000 per month we find here. And of course, there are some categories where there's just no uncertainty in terms of reporting, in the sense that it's just gasoline. So in our survey, people spend about on average $174 on gasoline per month. in the CEX is 176. So it looks like actually the pre-crisis wave matches up pretty well with what people in the CEX are reporting. So therefore, we have some confidence that actually these numbers are meaningful. And again, we have explored within individual variations. So therefore, to some extent, that people would make systematic reporting errors, this within individual variation hopefully would wash that part away. So now what we have here in the last column is just the log difference between crisis and pre-crisis wave. And here you see that on average, this is the number we discussed earlier. People actually cut their spending by about a third on average across all categories. But again, there's quite some heterogeneity across individual categories. So here, if you go to leisure activities, cinema, travel, and things like that, you see a dramatic drop in spending on those leisurely activities. Similarly, people actually buy maybe less shirts and especially, I guess, pants, because if we do Zoom calls, you only need a shirt and no pants maybe anymore, I don't know. Similarly, also you see people actually don't invest maybe in home improvement projects, at least in the early part of the pandemic. But also here you saw this dramatic drop in debt payments. So people actually didn't service their auto loans, their mortgages, or only to some extent. Instead, actually for other categories like food, also some drop, but not nearly as much. Also people cut less on medical things because they still want to maybe survive, and also for childcare and things like that. So overall, big drop, but also quite some heterogeneity across categories. As we said, so we benchmark it relative to the CEX. Those numbers actually line up quite nicely. Any questions for the spending stuff? Okay, so let me move on. So this was now all the non-durable categories. Now in terms of larger ticket items, so of course we know that these purchases tend to be quite lumpy. If you were to find now that maybe over the previous 3 months, people would have actually had very fast changes in durable spending, we might be concerned that anything we might find in terms of spending plans going forward could be driven by differences in this past lumpy purchases, which we actually don't find. But instead, actually, if you now, and of course, durables typically are the most volatile part of consumption, you see actually that going forward, people actually were planning to cut on durable spending by quite a big amount, about a third drop in planned spending on cars, houses, and larger ticket furniture and electronics. So this might also, paired with actually the past drop in spending, suggest that actually the recovery might be quite sluggish. So here are the numbers we discussed already a little bit earlier. So you see that about a little bit less than half of our participants report having lost some income. A bit more than half of our participants actually report that they actually lost wealth. The numbers are about 5,000 and a bit more than 30,000 US dollars that people have lost. Something actually that we initially were somewhat surprised is that it looks like that liquidity constraints were actually lower during the pandemic relative to the pre-crisis wave. So the way we elicited liquidity constraints is imagine you have an unexpected expense equal to a month of your income. Could you cover this expense due to savings, current lines of credit, borrowing from family and friends, and so on? And actually reported liquidity constraints in the survey slightly decreased, which now after a couple of months also seems to be consistent with what credit card companies are reporting, in the sense that people actually used their let's say stimulus checks or additional unemployment benefits to a large extent also pay down existing credit balances and things like that.
Michael? Sorry, there's a question.
Okay, can you hear me?
Yes.
Yes, hi. Well, it's another Michael Peterson from the Central Bank of Chile. So I'm very curious about these expected spending you had on the previous slide. You said that they were planning to spend like 30% less. I understand you've been doing this survey for a while. Do you have any idea about when people have expectations about the future spending, if they actually spent what they expect to do in a previous survey, and if not, what are the reasons? Is it drop in income and stuff like that?
Well, that's actually a great point. So unfortunately, so far, we've actually never looked into that. But given that we now, as you say, we have a quite nice panel component, we not only have plans to spend on durables, but also retrospectively ask them whether they actually did purchase durables. So we could definitely focus on the panel dimension and see whether plans line up with ex post realization. So far, we actually haven't looked at that, but that's definitely something we would be able to do. And I agree with you that actually this would be quite interesting in looking into that.
Okay, thanks.
Okay, so then we also asked individuals, so in early April, so how long do you think it will take until the situation returns back to normal, and how long do you think actually will still be under lockdown in your location in case they actually were under lockdown? And here you see that, on average, people thought lockdowns would be a little bit less than 3 months, actually pretty accurate in terms of how long on average across the US lockdowns actually lasted. But there was also quite a big right tail in terms of those expectations. So the 90th percentile was more than half a year under lockdown. And similarly, on average, people thought it only takes about half a year until we return to normal. And the 90th percentile were, however, more than a year. And so, again, I would be quite curious to see now, given that, I don't know whether we've ever actually left the first wave in the US, given that cases again in between have been rising quite fast in the US, how these numbers actually changed from April till July. So now let's talk a little bit about expectations. So I personally at least think that inflation expectations are, of course, a key input for individual decision making, especially right now when the nominal rates are low and certainly won't react to inflationary pressure. So therefore, whenever we see movements in inflation expectations, if nominal rates are fixed, they should translate one-to-one in movements in perceived real interest rates. And then, of course, will shape savings and consumption decisions. And here what you see is actually that in April, inflation expectations actually had decreased by more than half a percentage point, which of course means that if now the nominal rates don't move, that perceived real interest rates actually went up, which might help partially explain why spending plans and spending decisions actually have been going down, but also similarly that to the fact that many economists somewhat disagreed whether we'll see now inflation or deflation down the road if we actually focus on in the individual level inflation uncertainty. And the way we measure that is we have a full distribution of inflation expectations going forward. So therefore, we can actually look at the standard deviation of individual inflation expectations. And here we see actually that the standard deviation actually also went up by about a little bit less than a third of a percentage point, which again, through the lens of maybe some precautionary needs, might help us understand why people actually increase savings and actually decrease their spending. In terms of more subjective macro expectations, so if you ask them, what do you think actually happened now to the unemployment rate, you see that it actually skyrocketed by about 11 percentage points. It also looks like individuals think actually the movements in the labor market are rather persistent. So actually even a year down the road, little recovery in unemployment numbers, and even over the intermediate term of the next 3 to 5 years, we still see an increase of about 1 percentage point in April relative to January. Now, in terms of interest rate expectations, of course, one of the most relevant interest rates where people tend to also be most informed about are, of course, mortgage rate expectations. And here, as we discussed earlier, it looks like actually it's almost like a permanent parallel downward shift of the term structure of mortgage rates, in the sense that individuals perceive current rates went down, but even as far as 5 to 10 years out, mortgage rate expectations are flat, which, at least through the lens of mortgage rates, would suggest that potentially binding lower bound on interest rates might be here to stay actually for quite some time to come. Any questions in terms of expectations? Okay, if not, so let me move on. I think we've discussed these statistics now quite extensively together. So now what we're going to do in the remainder of the talk is get a little bit of an idea, at least, which chunk of those movements we saw in the survey is due to potentially direct health concerns. I now see people being hospitalized to the virus, and therefore I don't go out anymore, stay at home, take care of maybe family members and so on, or which part of these changes are direct effect of policymakers imposing lockdowns, because we have to, of course, understand the costs and benefits of these policy measures. As economists, you can say rather limited amount of the benefits of lockdowns in terms of saving lives. There are other experts that have better things to say, I guess, but at least in terms of getting an idea how costly in economic terms lockdowns are, I think it's useful for also lots of the policy decisions people have right now, for example, in Europe. So Germany, where I'm from originally, they have been quite successful in taming the virus, at least the first wave, but now cases slowly start increasing again. So they want to actually again increase the mask wearing mandates in different public spaces. And so these type of things, of course, then will be crucial to shed some light on these policy choices. Now, effectively, what we are aiming to do is now to understand some of the outcome variables. So why will be later on spending or expectations of individual I residing in county J at time T, and T is either our April wave or it's the January wave. We only focus on individuals that participated in both surveys, so therefore we can have an individual fixed effect. And then we want to actually understand, what type of, let's say, movements and spending is due to lockdowns, and what change in spending is due to the arrival of COVID-19 at the local level that we measure by the share of the population in the county that has contracted the virus. Now, of course, if you were to run the specification, you might be concerned that lockdowns are not randomly assigned. They might be occurring for the very same reason that I don't go out shopping anymore, because I'm somewhat concerned I see my neighbor contracting the virus, and policymaker also sees that. That's why he or she actually imposes a lockdown. So we try to actually tease out econometrically the part of the part of the change in behavior due to lockdowns versus direct effects of potential corona concerns. And then, given that our policy measures actually...
Just one clarification question, because I think I missed it. This lockdown variable is compulsory lockdown, or is also, so it could be a case that just one guy decide not to go out and spend because just fear.
So here is in the specifications later on we use a survey answer. Are you currently in your location under mandatory lockdown? So our hope, so we make it clear in the survey that it's a mandatory lockdown, and our hope is that people actually understood that this was not a self-imposed lockdown. And so I have a little bit of some external evidence that it looks like actually lockdowns are the important part. not really the local health concerns. I'll talk a little bit about that in the next few slides.
Okay, but you're gonna have like individual variation in lockdown for a particular county, for instance. So maybe there is a county that do not have a compulsory lockdown, but some individual decide to go out because whatever reason, whereas another individual decide to just stay in. This is something you have.
Actually, yeah. So theoretically we could have that, but so you see that actually within county, if we ask them, are you under mandatory lockdown? You see that pretty much everyone answers the same, in the sense that either everyone says in a county they are under mandatory lockdown and others are not. I think if you would have asked them for voluntary staying at home, this would have actually maybe also been interesting to study. But here we had focused on the mandatory lockdowns.
I see. So then the United that you are concerned is at the county level, so that some counties decide to put lockdown because some reason. Okay, I see.
Exactly. So the concern is to imagine now I've been in the US for 11 years and I don't know who the person in charge of counties is called. The county commissioner, let's call him this way, I don't know, sees now the first COVID cases arrive, and I, as an inhabitant of that county, also see people getting sick and maybe dying, and that's why I stay at home and don't go shopping anymore. The county commissioner imposes a lockdown because of exactly the same reason. And then it could be the case that I, as an econometrician, observe people spending less when lockdowns occur, but it's not because of the lockdown, but instead it's maybe for my personal health concerns. So that's one of the concerns we try to tease out.
I see. Thanks.
So here let me just graphically show you how lockdowns are spread across the US. So on the one hand, you see that this is now just here in the northwest, parts of the Midwest, in the northeast and northwest. There are quite some lockdowns, but you also see that this is, I guess, what people call flyover county or country in the US. So this is just very poorly populated areas in the US for which we actually don't even have survey responses. And so now directly talking a little bit about what triggered lockdowns in the US. And now what we actually have here now on the y-axis is the share of counties that are under lockdown over time. And in the same graph also the share of counties with at least 1, 10, or 100 COVID-19 cases. So you see that counties with at least one case clearly actually lead for most of the period lockdowns. But instead actually lockdowns seem to actually be leading like 10 or more than 10 cases over time. So it looks like it only takes a handful of cases that, until local politicians impose lockdowns, and you don't really need many cases for lockdowns to occur. We're looking at this differently. So this is now a plot of the cumulative share of counties under lockdown as a function of COVID-19 cases in the county. And you see that, less than 10 cases or so result already in about 75 to 80% of counties being under lockdown. So what we take away from those two plots is that it literally takes only a handful of cases of COVID-19 in the county until a local politician imposes a lockdown. And then the hope is that this handful of cases does not directly trigger, a reaction of individuals changing their behavior. To some extent, what we have in mind is that if there are few cases, people might not even be aware of. The initial occurrence of these cases might be largely due to idiosyncratic travel reasons. So, for example, in my home country of Germany, the first cases all occurred pretty much because people went skiing in Ischgl, and then they actually spread it across the whole country because of some carnival activity. So these type of things, that's what we have in mind. So it takes a handful of cases, and the spread of those initial cases locally are rather random. So again, concern is that the reason why we have lockdowns and people change behavior are jointly determined. And so what we ultimately need to assume that the initial spread of cases is for idiosyncratic reasons, and these few cases that it takes to have see a lockdown locally do not directly trigger also a behavioral change of our survey participants. So on the one hand, we directly control for the share of COVID-19 cases at the local level, to some extent hoping to control for potential direct health concerns, but we also actually want to provide some external evidence that this exclusion restriction we are assuming might not be completely far-fetched. So we talked about that. So what we are doing here, it's effectively some event study analysis where we use Google mobility data. So it's retail mobility, how much based on Google searches, how much do people go to, let's say, retailers, haircutters, and stuff like that. And we do that on the one hand, day 0 in red, that's the first COVID case in the county, and in black, retail mobility around the imposition of lockdowns. And while you see actually that there's a quite dramatic change in retail mobility, once you see lockdowns, there's slightly a decrease in mobility, maybe, around the first COVID cases, but it's barely noticeable. So it looks like indeed the big driver of a change in behavior are lockdowns rather than COVID-19 cases, at least the first cases. And so this is now our first stage. So the first stage on the left-hand side is a dummy that equals 1. If individual I reports that he is currently under mandatory lockdown in County J in our April wave as a function of a dummy that equals 1, if the first COVID-19 case has occurred in the county, and then directly controlling for these health concerns, the share of the population at the time of the survey that actually has COVID-19. And you see a pretty strong first stage. So if you measure the first COVID-19 case at different points in time, we had our survey in the field in the first week of April. So throughout, you see a strong first stage of this dummy variable that equals 1. If the respondents reports being under mandatory lockdown, instead, actually, you see that this direct health concern doesn't really play a big role in the first half of March, and only later on marginally becomes significant. So therefore, in our baseline specification, we use March 15th in our first stage instrumenting for the lockdown at the local level with the first COVID-19 case. So effectively, the way to think about the specification is we exploit variation in the timing of lockdown. So it's a purely cross-sectional variation, meaning that we have a missing intercept, or we cannot actually identify general equilibrium effects here. But so this is our first stage. And then
sorry, I think I missed something. Could you explain again? Would you elaborate a little bit about the exclusion restriction? So why this dummy do not have an impact of the outcome variables?
You mean the first COVID case? So yes. One concern is, now I see my neighbor contracting the virus and I change my behavior. I don't go out shopping anymore and things like that. So what we have in mind is, on the one hand, that the first case is very unlikely that I personally am even aware of it. And so therefore, I don't directly change my behavior. Crucially, also, there's now a series of papers documenting that quite a big chunk of Americans actually didn't take the virus seriously, at least initially, thought it's just some flu we don't really have to take into account. But of course, could still be concerned that people actually already changed behavior because of the first COVID-19 case. And so this is pretty much the best evidence we have, which at least for us seems to suggest that it's maybe not a direct concern, is that here this is Google mobility, retail mobility data, and the change in retail mobility at the county level around first COVID-19 case in red, or around the lockdown in the county in black. And you see only mild changes in behavior as measured by this retail mobility, but a big change in behavior after lockdowns are imposed. So, of course, this doesn't prove the exclusion restriction, but at least it would be consistent with it.
I see. Thanks.
Okay, so now what we're doing here is now the second stage where we use the instrumented lockdown as the explanatory variable. Outcome again, all the things we've looked at earlier. We also directly control for the share of the population at the county that has contracted COVID-19. And so, this is another way of seeing whether direct health concerns potentially are driving any of the variation we see across counties. And so at least here, it looks like across most of the spending categories, direct health concerns don't seem to be actually playing a major role. But instead, actually, if you compare the average drop in spending for counties that are under lockdown early versus under lockdown late, at least so in terms of a cross-sectional sense, you see that a big chunk of the overall drop in spending we saw earlier seems to be due to the imposition of lockdowns, in the sense that you remember the earlier number, you saw about a drop in total spending of about a third. You see actually very similar drops in spending coming due to the imposition of lockdowns. And again, very similar to before, we see a heterogeneous response across categories and largest drops in more discretionary parts of spending like travel, leisure, and stuff like that. Less so for more things of daily needs like food, utility, and medical expenses. Similarly, for the expectations part, similar to what we saw earlier, the change in expectations for inflation due to lockdown, drop in level, increase in uncertainty in terms of contribution of lockdowns relative to a direct health concern. It seems like that lockdowns are again a big driving force. Similarly for the unemployment expectations, and again, similarly also for mortgage rates expectations, in the sense that this parallel downward shift, and again, it seems like a big chunk due to the imposition of lockdowns rather than direct health concerns. Now, I mentioned earlier, we also looked at, this is maybe a bit more for our own fun rather than maybe pushing it too strongly. We asked, how much do you approve or disapprove different political institutions on a 10-point Likert scale? 1 meant completely disapprove, 10 means fully approve. And so here, this is now, we didn't have that in the January wave, so in this sense, it's a purely cross-sectional regression this time. So what you see is that, people don't really have strong views for Congress or the Federal Reserve, so nothing here statistically significant. But you see that people actually under lockdown have a higher approval of the CDC, the Center for Disease Control, and a dramatically reduced approval of the president. Remember, it's a 10-point scale, so you see actually a drop in approval of 6 points, which is actually quite large.
Michael, there is a question. Sorry.
Hi, Michael. This is Alvaro Aguirre. Do you hear me?
Yes, Alvaro, I hear you.
Yeah, I would like to come back to Luciano's question about the instrument, because if I understood correctly, the idea is that those counties where there was the first case of COVID earlier, that means that this evolved, right, for few days, few weeks, and then those are the ones that suffered the most, and then the lockdown was imposed there. If that's the idea behind the instrument, or I'm wrong?
Well, so I think the way you framed it now, this would be somewhat concerning for us. So if I understood your point correctly, then it would mean like the first cases result in bigger initial, I don't know, overburdening of hospitals, health concerns, and people see that, and that's why they don't go out anymore. That would be worrisome for us, because then the lockdown might just be endogenous. So our idea is that lockdowns occur as soon as you see the first 1 or 2 cases, and the first 1 or 2 cases don't directly trigger a behavioral response of individuals. And so, at least concerning the first part here, you see that as soon as if you've 1 COVID case, you see already 40% of counties be under lockdown. 5 COVID cases, already 65-70%. 10 COVID cases at the local level, more than 75% of counties already are under lockdown. And so in terms of think about the counties, so Chicago, where I live, it's the 3rd largest city in the US. It's part of Cook County. So think about like 10 million people. You have 10 people having COVID-19, and Cook County is being shut down. So initially, I think so. A good example is Cook County started being under lockdown, while the day before we still had St. Patrick's Day parade. St. Patrick's Day parade. So meaning like people actually didn't really change behavior, despite the fact that already more than 10 COVID cases were in Chicago. They went out pub crawling and stuff like that, and really only changed behavior once the lockdown was imposed. And so one way also of
but still you're assuming that there is some so the politician that is determining the lockdown has different expectation that the population, right? That's the assumption, that for some reason these guys see that something is happening before the population or something like that, and then the lockdown is because some reason that is not in the mind of the people that is consuming or something. You need
I think like that's a way of framing it. Yes.
Okay.
And so framing it this way, I guess one concern could be that, I'm not sure whether I would call that a concern. So the reason why people are then reacting to the lockdown could be then more a way of maybe think about this signaling channel of monetary policy, a la Nakamura and Steinson. So I didn't take that into account as a person living in Chicago, and then the Cook County commissioner shuts down Chicago. And then I start realizing, oh, well, we are really in deep shit. I cannot go out anymore. And so I changed my expectations and behavior, not because of the lockdown, but maybe because I update my belief about the severity of the pandemic. I think that that might be partially going on. We have a little bit of evidence ruling that out, but I don't have it in the slides today.
Okay, thanks.
I think I have 10 more minutes, so let me actually come to the conclusion, and then we can maybe discuss these points a little bit more in detail still afterwards. So, effectively all we are trying to do in this paper is to provide some a bit more real-time estimates on key macro quantities, both in terms of what has happened, losses in income, wealth, spending, but also then actually more forward-looking information in terms of spending plans, what people think will happen to the macroeconomy, because these will be, of course, key crucial inputs in decisions for individuals, the ultimate expectations. And something we by now actually have a working paper out is to get an idea of how different information treatments or policy communications change behavior. So we did as part of the survey also information provision experiments. So some people didn't get any information. Some people were told about information coming from the US Center of Disease Control. Others actually were told about the policy action by the Federal Reserve, that they were cutting interest rates to 0. And another quarter were told what the Senate and Congress were passing in terms of stimulus checks. And so somewhat interesting to us, so actually providing individuals objective health news was making actually them somewhat more optimistic, also in terms of unemployment expectations, things like that. This now partially is actually consistent with a little bit maybe of a policy signaling effect. Once you actually told them, that the Fed had cut interest rates to zero, as they did during the Great Recession, or if you told them actually that the stimulus package was X trillion, the largest in history, they actually became more pessimistic again. So it looks like somewhat, I think Alvaro, you had mentioned that, consistent with this, policymakers maybe see something else, and then their action might tell something to individuals, could be partially what's going on also for the lockdown effects. So that's pretty much all I've prepared for today, and I think now we have a couple of more minutes to discuss a bit more future directions and things that might be interesting to look at.
Thank you, Michael. So please, if you have questions, write in the QA chat, and we're gonna open the microphone for you. In the meantime, Ernesto?
You go ahead, please.
Oh, okay, thanks. It's just one curiosity. If I'm reading correctly your results from the regression, so you are saying that almost all that decrease, all the drop in travel, recreation, and entertainment is due to the lockdown. So there is not effect of maybe fear, or so. In other words, if you open the lockdown, you release the quarantine, so the lockdown now, even with a lot of cases of COVID, you're gonna see an increase in this kind of consumption in entertainment, in recreation. Is this a takeaway of the regression?
Yeah, so there may be two parts or aspects of your questions. On the one hand, so to the extent we only have in that part cross-section variation, we don't see any level effect. So of course, you can benchmark the level effect due to the unconditional change. And so it looks like everyone, let's say, is cutting spending, but you see this differential spending cut is substantially larger by a big chunk for the lockdown counties relative to the non-lockdown counties. And so if you were to make a back of the envelope calculation, I think in the paper we discussed about, I think it's about 80% of the overall drop in spending is coming from the lockdown counties. But this is, of course, an answer conditional on early April, not having that many cases yet and all of that. So I wouldn't feel comfortable saying that conditional now reopening the country consumption. So on the one, I don't know whether it's a metric would actually increase by that amount relative to countries that stay under lockdown. And crucially also now the information set of agents is different on all of that. So therefore, I think it's more a point in time answer, and I don't feel comfortable making an unconditional statement here. So I think all we are trying to say is that in this very situation, imposing lockdowns was costly in terms of aggregate demand and business activity, but we are not saying that it was not the right decision to do, because, at some point cases went down substantially and they started skyrocketing again once actually lockdowns were lifted. So we are just trying to get some estimates of how costly potentially lockdowns are in terms of drops in demand.
Okay. Thanks.
I have similar questions, so shut up.
Well, maybe then I have a question for you. So how's the situation right now in Chile? Can you go to the bank, or is everything shut down?
Everything is shut down, but right now they're starting to relax a little bit the lockdown restrictions. They make it like 4 or 5 phases. Phase 1 is the most stringent, and now certain parts of the city and the country are going to stage 2, and others are going to stage 1 actually.
I see. Okay.
So actually the question, and right now also there is, for a bunch of reasons, there are like a fiscal stimulus on, or people are receiving transfers. The way that those transfers are financed, whether they come from their own pension accounts or they come from the fiscal transfer, varies. But in all cases, people are getting more disposable income these days. And at the same time, lockdown restrictions are being released in some part of the city.
I see. Okay.
That's why, at least the way I see it, this geographical distinction between places with lockdown and without lockdown is very informative.
Mm.
So please, if you have any other question, write right here in the Q&A chat, and we will now open the microphone for you. Okay. So I think there are no more questions. Thank you, Michael, for this great presentation. Now, please don't leave. We're gonna come back to the practice session. Thank everyone for attending the seminar, and we hope to see you next week. Thank you, Michael.
Thank you for having me. It was lots of fun. Thanks.